Hi there, welcome to another live webinar with us from Phillip Nova. My name is Sri and I'm your facilitator of the day. What are we discussing today? We are talking about trading essentials and introduction to trading options. As we know, options are gaining in popularity right now, and in options trading, you can leverage a smaller capital for potentially higher returns. You can hedge against the market risks and benefit from market volatility. If you're wondering how options can fit into your portfolio or just simply unsure of how to get started, this webinar will be the essential guide for you. And you will learn the basics of options trading, key concepts, as well as fundamental strategies. And before we begin, I just would like to touch on two options promos that we have ongoing right now. We have you can trade the US stock index futures and options at only 0.98 cents. Um, and there's one more which we are running as a flash deal, and that's our COMEX Gold futures and options at only 50 cents. This promotion is valid only in August. Okay, so today, as we have, who do we have in the studio? We have Danish Lim, he's our investment analyst for Philip Nova, and he will be covering essential points for options trading. Basically, he'll be touching on the introduction to options, the option payoff profiles, how do you identify the payoff for long and short calls and puts, basic option strategies, and then you have an opportunity to ask Danish questions about options trading towards the end. And Danish, I believe he let me know earlier, he'll be walking you through the platform, the Philip Nova 2.0 platform, and you have a better understanding of how you can trade options with this platform. Okay, Danish, if you're all set to go and your slides are booted, I'll hand the time over to you very shortly. Members of the audience, if you're tuning in right now, please let me know in the question box if you can hear me loud and clear. Just head to the question box and let me know if you can hear me loud and clear. Prem, I have a question. You're asking if we will get this recorded session. Yes, this session is recorded. You will be able to, you will get a link in the follow-up email so you can revise what was covered in this webinar. Okay, members of the audience, if you can hear me loud and clear, just let me know you can hear me loud and clear. Brilliant. Thank you so much. The answers are coming fast and furious right now. I appreciate it very much. Looks like Danish is all set to go. It's working from one of our satellite offices, I see. Danish, if you're all set to go, the floor is yours.
All right, thank you, Sri. So thanks everyone for coming. So today's session will be about the trading essentials, and it's pretty much an introduction course when it comes to trading options. So before we proceed, just a short disclaimer. This presentation is intended for educational purposes only because we do not take into account your specific investment objectives, your financial situation, as well as your particular needs. So this rough outline of today's webinar. I'll first start off by introducing options, what are the benefits of trading options, and then I'll end off by sharing some basic option strategies which you guys may have heard before, such as strangle, straddle option strategies. And I'm pretty sure all these will be pretty interesting for you guys, so do look forward to it. So to kick things off, what are the things that you need to know in order to place your first trade in options? I believe that most of us, when we just starting out, when it comes to trading options, some of us are quite confused. There's a lot of terminologies. However, do not worry. The very first thing that most of us should do is to first have a view of the market. If our view is bearish, we typically try to look at put options. If our view is bullish, we'll take a look at call options. So for those of you who aren't aware of the differences, I'll be going through them later on. However, the beauty of options actually lies in its flexibility. Um, Options actually open up a wide range of different strategies you can use. For example, I believe that some of us may be aware that the Japanese market over the past week or so has been extremely volatile. One day it could go down by 12%, and the very next day it could go up by 10%. However, with options, rather than having to bet on whether the market goes up or down, you can instead change your bet into betting on the size or the magnitude of the market move instead. I'll explain more about this later. So this brings me to my first point on why you should use options. They give investors a more flexible and complex strategies that will help them to profit under any market scenario. The market could be very volatile, as in the case of Japan, but with options, you can still figure out a way to make a profit. Other than that, options also provide you with a lower cost way to go long or short the market. Uh, when you do a traditional short sale, you may have to sell your assets in order to cover your short position. Options can also be used as a hedging device, uh, specifically protective puts. And lastly, you can also trade on volatility. The more volatile the market, you can actually profit using options. And when you buy a call or put, your loss is also actually only limited to the premiums that you pay. Now, some of you, I believe, could be a little bit confused. All these 5 points are pretty, I would say they contain a lot of lingo when it comes to options trading, but do not worry. By the end of this webinar, I believe that you guys will be able to understand all 5 points. So let's proceed. So to kick things off, what are options? Options are essentially a derivative product which is contingent on specific events. It's a contract between two parties, the option writer, which is the option seller, as well as an option buyer. The holder or the buyer of the option will have the right, again, it's the right, not an obligation, to buy the underlying asset from the option seller. Again, it's not an obligation. So as an option buyer, you can simply not exercise that option and you can just let it expire. So as I've mentioned, there are two types of options, calls as well as puts. For a call option, you are as a call option buyer, you are essentially have the right to buy the underlying asset at the strike price. On the other hand, if you're a put option buyer, you have the right to sell the underlying asset at the strike price. So there's a very big difference. For a call, you're essentially buying the underlying, but for a put, you are selling the underlying. So who are the parties involved? As I've mentioned, for a call buyer, you have the right to buy the underlying at the strike price. But on the opposite end of the trade, we have the call writer or the call seller who is obligated to deliver the underlying asset. For example, the underlying asset could be gold futures, for example. And as a call buyer, you're essentially, when you exercise the option, you'll be able to buy a gold futures contract at the strike price. And as the writer, you will be obligated to deliver the gold futures contract. Of course, this also applies to a put option. Put buyer has the right, but not the obligation, to sell the underlying asset, and the put writer is obligated to take delivery, basically receiving the underlying asset at the strike price. So what are some key terminologies? Firstly would be the expiration date. All options have a maturity date or expiration. And if you were to choose to not exercise it, these options will simply expire worthless. We also have the different styles of options. The main ones are European options as well as American options. American options can be exercised at any time before expiry, while European options can only be exercised on the expiration date. So a very simple way to remember this is that the A for American stands for anytime, while the E in European stands for only at expiry. Now, talking about the strike price as well as when do a buyer, when does a call buyer or put buyer exercise their option? Typically, when you are buying a call, you are essentially having a bullish view of the market. You expect market prices to go up, so you will exercise your option when the underlying asset price is above the strike price. So do take note of the letters I've put over here. moving forward, the current market price will be denoted as S, and the option strike price will be denoted as X. So on the other hand, a put option buyer, you exercise it when the market price falls below the strike price. So something to consider as well is that when you're buying an option, you are not paying the strike price. What you're paying is actually what we call the option premium. It is the current market price of an option contract. And you can see over here in this screenshot I provided, uh, you can see that on the second row over here, it's essentially the gold December options contract. The C2400, what it means is that it's a call option and the strike price is 2,400. And again, the option premium that you pay is essentially based on the bid-ask quotes. So when you trade an option on the market, you're trading through the option premium, not the strike price and not the underlying price. And the important thing to take note is that the premium is the income that is received by the writer of an option contract. And as an option holder, it's the price that you pay. So talking about option prices, what drives these option premiums? So to put it very simply, there are more complex models when it comes to deriving an option premium. You may have heard of the Black-Scholes models, but to kick things off, a very simplified option pricing model, at least for the option premium, it consists of two parts: the intrinsic value, which is the payoff of the option, as well as the extrinsic value, which includes time value, as well as volatility of the underlying asset. Now this may sound complicated again, but let's proceed slowly and try to understand what these terms mean. So for example, when you go long a call, which means you're buying a call, the payoff to the call buyer essentially is denoted by the underlying price, deduct and then you minus the strike price. So the whole logic behind this is that when you are buying a call option, essentially when you exercise it, you have the right to buy the underlying. And when you buy the underlying, it's a cash outflow. So for example, let's say you buy an underlying at maybe $10, you're essentially paying out $10. So it's minus 10. And the idea is that when you receive that underlying, you can sell it in a market uh, at a higher market price. So this is a rough payoff, uh, and then we have three different terms: in the money, at the money, and out the money. For in the money options, again, we call it in the money when the payoff is positive, which means that there is benefits to exercising the option, and this formula of S minus X is positive. On the other hand, let's say there's no benefits to exercising the option. The market price is below the strike price. We call it at the money options as well as out the money options. And for both these two options, the payoff is zero, mainly because as an option holder, you have the right to simply not exercise your option. So it could be a bit confusing, but if you guys are still confused, do leave your questions and then I'll address them later on. So on the other hand, we have a long put, which means you're buying a put, and the payoff diagram, the payoff formula is essentially just reversed. It's strike price minus the underlying price. And again, when you long a put, it's in the money when the market price falls below the strike price, and this is the payoff. Talking about payoffs, and then intrinsic value. Again, the intrinsic value is essentially the payoff of the option when it is exercised. And the main reason, the main thing to take note of is that, as an option holder, again, you have the right, but not the obligation to buy or sell the underlying. Therefore, because you can simply not exercise, the intrinsic value cannot be negative. So we have these two formulas over here. The intrinsic value of a call option is the maximum of zero, which means zero is the lowest that the intrinsic value can go, and the highest is essentially the payoff formula which I showed you previously. So again, when an option will have intrinsic value when there are benefits to exercising the option, and then we call it in the money. When an option is at the money or out the money, intrinsic value or payoff is zero. and you'll choose not to exercise them. So how does all this option moneyness actually affect its price or its premium? Typically, in the money options, they'll have a higher premium because these options can already be exercised at a profit. You can essentially just buy the option and then exercise it, and then receive a positive payoff. At the money options as well as out the money options, they will have a lower premium because there's a higher likelihood that the option will expire worthless. The option could be still very far away from being in the money, for example. So to better demonstrate this concept of option moneyness, let's take a look at the gold futures. You can see at the top over here that the current price for gold futures, at least for the December contract, is about 2,503. And if you were to look at the list of all the different call options over here, uh, based on their strike prices, we can see that the different strike prices, you can see that again, let's say you can see that based on the different bid ask quotes over here, that essentially the prices or the market premium is actually decreasing. One reason for this is because in the money options, as I've mentioned, are more expensive. Why are they in the money? Recall that for a call option, it's in the money when the market price is above the strike price. So let's take this slowly. The current market price for the underlying is about 2,503. So an in the money call option will have a strike price that is lower. So all these options, at least from 2,500 and above, they are all in the money. So you can essentially exercise them and then receive a positive payoff. On the other hand, all the money options are cheaper because there's no intrinsic value, and they may not be you may not be able to exercise them at a profit. So what are the other factors that influence option prices? There are 6 major factors. The price of underlying exercise price essentially represents whatever I've just mentioned. And then for today, we'll be focusing mainly on the time to expiration as well as the volatility of the underlying assets. When we talk about time value of options, it's given by this formula over here, which is you take the option premium and then you deduct the intrinsic value. But let's ignore this option for a moment and just focus on what this time value of options mean. It essentially says that the longer the time to maturity, the greater this time value of the option will be, because as an option writer, when you're writing or when you're selling an option, you require a greater compensation or greater premium because over a longer time frame, let's say 60 days, there's a higher likelihood that among one of these 60 days that the option may move in favor of the option holder. And then on the other hand, let's say the time to maturity is shorter, maybe it's like 1 or 2 days. The option essentially only has 1 or 2 days to move in favor of the option holder. So there's less likelihood that the option writer may see a loss. And I think it's very easily represented by this graph over here, where the longer the days to expiration, you can see on this left, there's 90 days to expiration. Time value is at its highest. However, as it approaches expiry, this time value will decrease to 0. And because of this, typically at expiry, the option premium consists only of the intrinsic value of the option. And when we say intrinsic value, do recall the payoff diagram, the S minus X and X minus S that I showed you previously. So again, you can see over here that based on the different option contracts, we do have the spot market, the spot gold futures contract over here. And then we have the December options, the January 2025 options, February 2025 options. So you can see that there's longer time to maturity or time to expiry, and you can see that the bid ask prices are gradually go higher. This means that the longer the time is to expiry, the more expensive or the more expensive the premiums will be. Then next, I'll be talking also about the volatility. When it comes to options, volatility is a very important concept. Volatility actually isn't, I would say, isn't a very negative thing when it comes to options. Uh, for options, we typically use a term that we call implied volatility, and this is essentially just a market forecast of how a security or how an asset price will move in the future. This is not historical volatility. When we talk about historical volatility, this is actually refers to the past market changes as well as the actual results. So for options, typically premiums are priced based on the implied volatility. For example, let's say there's a higher implied volatility of an option or of gold prices. Uh, Gold prices are a lot more volatile, which means that it's more likely that the gold prices will move in favor of the option buyer. They may see a larger up movement or a larger down movement. And because the movements are larger, it's more likely that the option will, become in the money, which means that it could go higher than the strike price if it's a call option, or it may go lower than its price if it's a put option. Therefore, uh, I think the main takeaway over here is that higher volatility generally for options, especially let's say if the market is very volatile, you're more likely to see higher option premiums, which means that the prices that you trade on the options on the market will be higher as well. So again, these are the 6 major factors that affects the premium of options. You can take a picture of this. Uh, I think it's a very good thing to keep in mind if you are to continue trading options. So I think we have come to the key question. When do you actually make money from options? Again, I'll show this entire slide again. For a call buyer, your payoff comes based on this formula, which is the underlying price deduct the strike price. However, as an option trader, you have to keep in mind that this payoff isn't equal to your profit. Because again, we need to remember that we're actually paying the option premium to own the option. You can see on this diagram over here on the right. I think this diagram, actually represents or shows this relationship pretty nicely. the the straight line, the bolded line, it essentially shows the payoff of a call option, excluding the premium. The dotted line actually, it shows what your real profit is. It shows that essentially before the underlying price exceeds the strike price, your loss will be the cost of the option, which is essentially the premium. And in order to profit, you need to essentially hit what we call the break-even point, which is the exercise price, and then you add the call premium, because again you are actually paying the call premium. So from this diagram over here, if you're a call option trader, you will only see positive profits once the underlying price moves above $104. So this is the break-even point, and this is the profit. The profit as a call buyer will be calculated by the market price, deduct the strike price, as well as deduct the call premium that you're paying. On the other hand, for the long put, again, the payoff is X minus S, and again, the payoff that you're receiving is not the profit due to the option premium that you're paying. And the profit to the put buyer is very similar to the call option. You have to again include the calculation of the premiums that you're paying, and the break even will be calculated by the strike price deduct the premium. So in the case of this put option on the right, the long put buyer will only profit once the underlying price moves below $126. So to understand this, this kind of option payoff diagrams is actually pretty simple. The horizontal line is the underlying price. The vertical line is the profit and loss. Below zero, it's essentially a loss. Above zero, it's a profit. And you can see over here that the dotted line essentially is in positive territory once the underlying price uh, goes below $126, which is why we say that the break even for this put option is $126. So now we've come to the basic option strategies. I think this will probably be quite an exciting part of this webinar. Firstly, I'll talk about what we call a protective put. Uh, in order to execute this strategy, it's essentially a long position in an asset as well as a long put, which means you're buying an asset and you're buying a put. The asset can be anything. It could be gold futures, it could be silver futures, it can be anything that you're holding, as long as you're going long on that asset. Typically, this strategy will be used to hedge downside risk while at the same time maintaining exposure to the upside, which is given by your long position in the assets. But you need to remember that your upside is limited due to the option premiums that you're paying on the long put exposure. So as an example, let's use COMEX Gold futures as the underlying. Do take note that these are all hypothetical prices. So given that the current, COMEX Gold futures, maybe it's priced at $12, so this is the underlying, and we have a long position on this COMEX Gold futures. So we also buy a put with a strike price of $10, and our cash outlay or our cash outflows is basically our put premium that we pay of $1. So the underlying is 12, strike price is 10, put premium is $1. So the profit and loss can be calculated by this formula over here. Firstly, it's your gain or loss in your underlying position. Recall that I mentioned that you're also longing, you're buying an asset. Let's say your futures, it goes up. You'll see a gain in your underlying assets. And then this, second term over here is the payoff formula for your put option. The lowest it can go is 0 because if it's not in the money, you can simply choose not to exercise it. And the profit or the payoff is denoted by X minus S. And then very lastly, we also have the final term is the put premium that you're paying. So let's see what happens. Let's say the market is in an uptrend. The underlying price of gold increases to $15 from $12. The profit you gain will be $3 in your long gold position, because you take 15 minus 12, you get 3, and your put payoff will be 0 because you can simply not exercise it, because again, for a put option, if the prices increase, it's out of the money. And then you have to minus the $1 that you're paying for the put premium. The ultimate profit that you'll get is $2. So you have to take note again that your upside will be limited due to the premiums that you're paying. If you didn't have this option, you will have a profit of $3. But with this protective put, your total upside is only $2. So it's $1 lower. In the alternative scenario, let's say the market is in a downtrend, the price of gold futures drops to $8 from $12. The loss on your gold position will be negative $4 because it drops from 12 to 8. And then you exercise your put because it goes below your strike price. The strike price is 10, remember? So the formula to calculate a payoff of a put is you take strike price minus the underlying. So you 10 minus 8, you get $2. So you have a payoff of $2. And then at the same time, you have to deduct the put premium that you pay. So the loss that you see is actually negative $3. So again, the losses that you have through this protective put option will be limited. And the main benefit is that you are able to receive downside protection, but at the same time, you also achieve, capital appreciation. You're still earning profits, but the only downside is that the profits you earn is limited by the put premiums you pay. So this is you can consider it as a form of a hedging strategy. Let's say you're longing an asset and you have a very bearish market view, but at the same time, you still want to maintain exposure to, let's say, the Nasdaq futures. You can essentially use a protective put strategy. So now we also have the next option. We have the sell or write call strategy. Um, Again, if you recall, a call writer is the opposite party to the call buyer. So the payoff diagram will essentially be the opposite of a call buyer. You just have to add a negative sign to the payoff of a long call position. And I think the main takeaway I want you guys to have is that when you're writing a call, you can see from this diagram over here, the maximum profit you're receiving is the premium that you're receiving from selling the call option. However, the loss that you could potentially have is theoretically unlimited. You see that this line extends to what is theoretically infinity, and this is because your underlying asset price can rise to any amount. Your Nikkei 225 futures can rise to, it can rise to, theoretically can rise to any amount. It could rise to 1 million. So your losses are unlimited. And this is what we call a naked or uncovered call, and it's actually quite a risky strategy to have. On the other hand, we could have a covered call strategy where instead of simply selling a call option, you hedge your position by buying the underlying asset while at the same time writing the call option. And the main benefit is that you'll collect the premiums from selling the call while also sort of offsetting the risk that you have from writing the call option. And this risk that I'm talking about is the unlimited risk involved due to the uh, theoretical loss that you see when the prices of the underlying rise. And we essentially call this covered call, can be referred to as well as a yield enhancement strategy. So for example, the COMEX gold futures price again will be $12. We long the COMEX gold, and we also write a call with a strike price of $13. So instead of paying premiums, we actually receive premiums of $1. So our profit formula will be given by this. We have a long position in the underlying. So we do have to calculate our gain or loss in the underlying. We do have to deduct our option payoff because we are the call writer. If an option is in the money, we of course enjoy the benefits of the payoff, but we do have to deduct the payoff because we are a call writer. The final term is that we add the call premium. So let's say the market is in an uptrend, the underlying price rises above the strike price, the call will be in the money. In this scenario, in an uptrend, the covered call strategy will underperform because you need to deliver the underlying asset to the call holder. But at the same time, you'll still be able to keep your option premium. On the other hand, let's say the market is flat, it's choppy, or it's range bound, you'll outperform because you will be able to keep your premium as well as the underlying assets. Lastly, in a downtrend, when your call is out the money, you will outperform because your premiums that you receive will help to offset the overall decline in the underlying assets. And the key thing about this strategy is that if you were to use it in a very volatile market, as I've mentioned, the more volatile it is, the higher your premiums are. So typically the covered call, if you want to generate more premiums or more income, it would be better to use this strategy when markets are more volatile. Now, lastly, I'll talk about the market outlook driven option strategies. I'll be focusing on neutral strategies. So neutral strategies are essentially used when, as a trader, you do not have a particular view on whether the underlying asset price, whether the Nikkei 225, whether the S&P will rise or fall from its current price. And these strategies are non-directional, meaning that the profit only depends on the size of the move, whether it increases by 2%, whether it increases by 5, or whether it increases by 10%. It doesn't matter about the direction. You'll receive the same profit whether it's negative, whether it goes down by 10 or whether it goes up by 10. So the ideal outcome for neutral strategies is for either the put or call to increase or decrease in value far enough to offset the premiums that you pay. There's two different types as well. We have a bullish on volatility, where we are essentially aiming to profit from the underlying asset, seeing very big price move upwards and downwards. On the other hand, we have a bearish on volatility, which means that markets don't move a lot. So underlying price per me move by about 0.5%, 0.2%, 0.3% in a very tight and narrow range. So these are two different types of strategies. I'll focus on the long straddle strategy because it could be a bit more relevant in today's environments. It is what we call a bullish on volatility strategy, and it typically used when we expect the underlying securities to see significant volatility in the near term. We execute this strategy by buying a put and a call with the same underlying strike price and expiration date. So if you look at this payoff diagram over here, I think the beauty of this payoff diagram is that it's pretty simple to see. You can see that the diagram is only in positive territory when the underlying price at expiration is either very, very high or very, very low. So the upside of the long shadow strategy is that your profit regardless of your regardless of the price direction, as long as the move is strong enough, whether it goes up high enough or whether it falls low enough. The maximum loss will be when the underlying is trading at the same strike price of the options that you buy, and which is equal to the total premiums that you pay. And you have to take note that for straddle strategy, you're paying premiums for two different options. You're paying the premiums for a put and a call option at the same time. So to execute a straddle strategy, you simultaneously buy a put and a call on the same underlying strike price and expiration dates. We buy an at the money call and buy an at the money put. In this example, we'll use COMEX Gold futures again, assuming the underlying COMEX Gold futures is at $20. And then we have an at the money and at the money call and at the money put at a strike of $20 each. Our cash outlay will be the two premiums paid. Recall again that because we are buying two options, we have to pay double the premium prices. So the key thing is that the price movement has to offset the premiums that you pay. So let's look at one scenario. Let's say the prices of gold increases above $20. It rises to $40. So the call option is in the money, while your put option is expires worthless. So this is the profit formula over here. Your payoff from your COMEX Gold long position is about $20, while your put position is your payoff is essentially zero because you just let it expire, you don't exercise it. And then you have to at the same time deduct the $10 premium that you're paying. So again, the profit here is $10, and there's potentially unlimited upside depending on the magnitude of the price increase in the underlying. So what happens if, let's say, COMEX Gold, it drops below $20 to $5? Your put option will be in the money and your call option will be worthless. So we have the profit formula over here. Recall that for a put option, the payoff formula is you take the strike price minus the underlying price. So the strike price is $20, and then you deduct the underlying price, which has fallen to $5. So the profit or the payoff that you'll get from your put option that's in the money will be $15. Your call option will be worthless because it's out of the money, so it's zero. And then you have to deduct the premiums that you pay, so it's $5. So you can see that through this two option positions, it doesn't matter whether the COMEX Gold futures, whether it increases or decreases. What matters is essentially how much or how large the price movement is. Let's say the COMEX Gold, it doesn't change, it stays at $20. Both options will expire worthless. So your loss will essentially be the premiums that you pay, which is a negative $10. And very lastly, the break-even point of a straddle strategy, it depends on both the premiums that you pay. So it's essentially the strike price plus or minus both premiums that you pay. And you can see it on this diagram over here. The strike price is 20. You only profit. Your profit is only in positive territory once you deduct both option premiums that you're paying. Lastly, we also have a strangle strategy. It's very similar to a straddle, except that you're buying an out the money call as well as an out the money put. So for out the money call, the strike price is higher. And for an out the money put, the strike price is lower. So you can see from this diagram over here that on the left side, we have the put option. It changed from 20 to 15. The strike price of option that's out of the money will be lower at $15. And then for the out the money call, the strike price will be higher. From 20, it increases to 25. So the upside and downside is very similar to a strangle strategy. Upside is potentially unlimited, again depending on the magnitude or the size of the price movement in the underlying. The downside is, however, limited to whenever the underlying, or let's say for example gold futures, trade within the strike prices of both options. So for this example, you'll trade between $15 and $25. So to summarize all the different strategies, firstly we have the protective put. It's again a long underlying position, such as a long gold futures, and then we buy a put as well. So by paying a premium for this put option, we hope to limit the downside, while at the same time maintaining exposure to upside potential in the underlying asset. We do have to keep in mind that upside potential is limited due to the premiums that we're paying. On the other hand, we have a covered call strategy where we sell a call and then we buy the underlying asset. By selling a call, again, we are receiving premiums. So these regular premiums are essentially serve as a form of income. So we call it a yield enhancing strategy, where in exchange for your upside potential being kept, the yields or the premiums that you earn, they are typically a lot higher than average. They are higher than most of the dividends that companies out there give. And at the same time, because you're long the underlying asset, you still have upside potential to the underlying price. Lastly, we come to our long straddle and strangle strategy. These are non-directional, market neutral strategies. So this could be a little bit more advanced. You're not betting on any direction. You're just simply betting on the magnitude or the size of the price move. So let's say you're very confused or markets are very volatile. You are not sure, whether markets will open lower or higher, but you know that it's very volatile. Uh, you know that prices are likely to move by maybe above 5%, maybe in double digits. Straddles and strangles will be a good strategy to use because these are all strategies that are bullish on volatility, where the more significant the price move, the higher the profit you will see. So returning back to our very first few slides, why should you use options? Again, as you can see from the straddle and strangle strategies, uh, options provide a more flexible as well as more options for you essentially to profit under any market scenario. The markets can be very volatile, and for let's say you're investing in traditional asset classes, when markets are volatile, typically investors will be hesitant. But for some option investors, they may thrive in a very volatile market environment. And with options, for example, using the straddle strategies, you do not need to actually have a directional view because, again, your profits depend simply on the size of the price movement. Again, it's a lower cost way to go long or short, at least compared to your short sale. Again, it can be used as a hedging device. Recall the protective put strategy that I mentioned. And you're also essentially trading on volatility. This is reflected in the strangle and straddle strategies, as well as the covered call strategies, where the more volatile the market is, the higher the premiums you'll receive. And lastly, when you buy a call or put, your loss is limited to the premiums that you pay. Let's say the premiums that you pay is $10. The loss is limited to $10. In contrast to traditional assets, where your maximum loss is when the asset price falls all the way to zero. So that's one of the biggest benefits of options as well. So um, I'll move on to the final section of this webinar. I'll just briefly demonstrate, how to navigate our Nova 2.0 platform using how to navigate options using our Nova 2.0 platform. So let me swap over to our Nova 2.0 platform. Okay, I hope you guys are able to see the platform over here. So this is our Nova 2.0 platform, and I have a list of options over here. So there's a bunch of different, option contracts. Again, the very first contract up there is the gold futures contract for December delivery. Again, this is in most of the scenarios that I mentioned just now. This is actually our underlying price. We have different, option contracts. The C2550, what it means is that it's a call option with a strike price of 2550. And the premiums are based on the bid ask prices. And then we have a put option, which is P2550. And again, the premiums are based on the bid ask prices. So to navigate this platform, let's say you want to add different types of options. You can simply go to around the top right over here. There's a button for us to add symbols. You can click on it, and once you click on it, it'll bring you to all the different product types of all the different product types that we have on Nova 2.0. So moving forward, let's say I mentioned about the straddle and strangle strategies. You can very simply execute this strategy with different asset classes. Nova 2.0 has, of course, a lot of different asset classes. Your underlying, for example, in a protective put, it could be different futures contracts. It could be, stocks. It could be other things as well. So let's say you want to buy an option. Let's say you're looking at option. You simply click on the option over here, and we want to look for gold. Or in this case, let's say we are looking for gold. You just simply hover over to a gold contract. Once we click on gold, we have all the different months. Again, recall that the further it is from expiry, the higher the premiums. So let's say we want to get a February 2025 contract, and you see we have all the different call and put options with different strike prices. And let's say once we have selected a put or put option, let's say we are choosing one near the current market price of about 2,500. Let's say we choose a call option at 2,550. We simply have to double click it, and this option will be included in our watch list. It's over here, the Feb 2025 gold call option contract, and the strike price is 2,550. However, do take note that for different types of options as well, there are different expiry. To find out more, you can simply right click the option, and then you go to this contract spec called contract specifications tab over here. Once you click on it, you'll see all the different, essentially more details about the contract. So you can see that for this Feb 2025 call option on gold contract, the expiry is on 28th of January. It's important to take note as well that for most for the expiry date of options are not fixed. They don't necessarily have to expire on all the same week. For example, gold over here expires on the 28th of January, which is the last week of the previous month. This is a February option. But let's say we want to take a look at the S&P 500 E-mini expiry. You see again that it's in the same month. It's a December option, and the expiry is actually somewhere in the middle of December. So there's all different expiries, and this is something as an option trader you have to keep in mind as well when if you are to trade options. So I believe with that, we've come to the end of this webinar session. Thank you for listening. And yep, I'll hand over the time to Sri, who will end this webinar.
Danish, I'm so sorry we can't let you go yet. It's time for Q&A. Okay, we have a couple of questions from Lian Li. Any of our other attendees, if you have questions, you can type them in the question box so Danish can address your queries. Lian Li, I believe your questions are in Chinese. I did Google Translate for that. You're asking about Comex Gold, I believe. This contract expires on the 15th of every month, and it's a even month contract. Okay, so expiry happens every even month. Okay, so that's your first question. Your second question, I don't have much clarity and about that. Maybe you can give a little bit more context. If not, we'll get in touch with you post webinar. Members of the audience, if you have any other questions, you can send it in the question box right now, so we can ask Danish to give us his insights about that. Danish, maybe would you be able to share? Based on what you've shared today about options trading, if I'm new to options, what should be the top three takeaways for me today?
Right. So I think the main takeaway I want to say, let's say if you're new to options, firstly is that options, like its name suggests, gives you a wide variety of options of how you can navigate the market. You know, you could go, you could buy a put contract, a put option, which is essentially similar to shorting an asset. Again, we have all the different strategies. We have straddle, strangle, which sort of transform and modify your risk exposures as well. And the second thing, especially for options trading, let's say, is that your loss, as I mentioned, is limited to your premiums that you're paying. Let's say you're for most traditional investments, the maximum loss is goes all the way until the asset it reaches zero. But for an option premium, it's limited to the premiums that you're paying because you can very simply just not exercise the option. So I believe I've answered most the questions that you have asked, Sri.
Yes, that's correct. So Danish, maybe for those starting out on options trading, are there particular type of options that you recommend that we explore or learn more about, or like try out first before we try the other types of options?
Yeah, so just to kick things off, I think the very first step again is to before we actually dive deep into all the different strategies that I mentioned, straddle, strangle, covered, protective, I think it's more, I would say it's simpler to simply have a market view and then you execute your strategy based on that view. For example, let's say have a bullish view on the market, you can use a call option. And then if you have a bearish view on the market, you can use a put option. And then once you're more familiar, you can slowly, move over to strategies which involves two assets, such as the protective put, which is you go long on an underlying asset, then you long a put option, and then you can move on to, instead of underlying asset, you have two positions in two options. And then you can even have more complex strategies where you have three different options as well. But if you guys are interested in some of these more complex options that's exist out there, you do feel free to drop us an email. We'll be glad to answer some of your queries. And I think the big thing is that uh, sometimes when the market is very volatile, like we saw the past few weeks, traders and investors they may get very confused. How should they act? How should they respond? Um, and traditional investments, they are most of the time when it comes to traditional investments, most investors are long only, meaning that they are only going in one direction. They're long, they're not short, they're not modifying their risk exposures, for example. And options provide you with that flexibility to help you navigate some of the markets in the more difficult times. Yep. So,
Danish, yeah, go ahead.
yeah. So let's say just for example, the market. Let's move away from volatile market. Let's say the market is very flat, it's very choppy. If you guys recall, this is actually the best scenario for a covered call strategy because your call won't be exercised and you'll receive, income or premiums, and this sort of serves as a, yield enhancing strategy. Uh, so let's say the market again, it doesn't move much. You see that over the past 2 or 3 weeks, the prices have only moved by like less than 1%. The highest it's moved is maybe 1.2, 1.3%. And sometimes, traders and investors, we get very, confused by such a market. So options again provide you with wide flexibility and wide variety of ways to navigate different market conditions. And I think that's the biggest strength of options as well.
All right, Danish, I'm not sure if you can see the question box. We have a couple of questions, but we might only just have time for one. For the members of the audience, just take note if we don't address a question during the live webinar, we will follow up with them post webinar, okay? Rest assured, we'll help to address our questions because education is a very big part of what we do. And yeah, so just send your questions our way and we'll address them post webinar if we need to. Danish, do you want to pick up one more question from the question box, and maybe you can just share a little bit more details about that.
All right,
Yeah,
let
do
me
read out
take
the
a look.
question as well, all right, and let us know who it's from.
So I think there's hold on, let me take a look at the questions. I think there's a question from Bong Kam Tim who asks, what product does option cover? Uh, he also asked that uh, I would assume that your question refers to whether it covers FCPO or crude palm oil. I would say yes. Again, I think I showed you the Nova 2.0 platform over previously. Um, most of the options that we provide, they actually cover futures contracts. So I think crude palm oil actually falls under one of them as well. So I think there's also another question. Okay, let me see. I think also there's another question who asks, I think from Jean Ang, who asked whether we are able to trade options on indices of SGX contracts. And the answer is yes. Specifically, I think I remember that there are options of the SGX Nikkei 225, and I'm pretty confident that there are other indices, SGX indices that we do have options on. So, if you do want more clarification, do just drop us an email. I believe my colleagues and myself will, answer and probably give you more details to some of your queries as well.
All right, that's all the time we have. I just saw one more question from Jean T. You're asking if the market data in Nova 2.0 is real time. Yes, it is. So that's a very quick one we can get out of the way. The rest of the questions that we don't have time to address in today's webinar, thank you so much for them. Rest assured, we'll get in touch with you post webinar. And Danish, thank you so much for all your wonderful insights. Looking forward to the next webinar from you. And thank you for taking time to address all our questions as well.
Thank you. Thank you. Thanks, guys. I hope you guys learned a lot today.
All right, members of the audience, till our next webinar or seminar, all the very best in your trading, and we look forward to seeing you in our next webinar or seminar. Take care, good night, and all the very best in your trading for the week.